Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're going to be taking a look at the performance of equity markets, both locally and internationally, for the first 9 months, can you believe it, of 2022. Now, it has been somewhat painful, a painful period for equity investors. Let's take a look at how our different markets would have performed and what investors might expect in the remainder of 2022 and going into 2023. When we take a look at local markets, well, local markets continue to stumble or tumble, led by that cross-listed index down 28.2% for the year. And those declines would have been driven in the main by major names with share price declines such as NCB Financial Group. Overall, the Trinidad and Tobago Composite Index, which also includes locally domiciled or all TNT companies, would have declined just about 10.3%, a further decline from its July or end of June position of being down around just about 7.7%. Our local boys or local companies would have fared relatively well in the current investment climate, down just about 3.3% overall. But again, not very good reading for local equity investors. Now, what would have contributed to some of those declines in terms of major movers on the Trinidad and Tobago Composite Index? Well, we have Angostura Holdings Limited and Agostini's Limited up just around 38.5% each at the 9-month period. Angostura reporting much stronger earnings, and Agostini as well, and continuing to go with diversification and acquisition initiatives. On the other end of the spectrum, NCB Financial Group down 43.8%, and that would have really weighed on the index, being one of the highest market capitalized or most significant stocks by market capitalization on the Trinidad and Tobago Stock Exchange, followed by heavy hitters such as Whitco down 21%, Unilever Caribbean down about 20% also, and First Citizens Group Financial Holdings also down about 20%. So some broad-based declines and significant declines for some major players on the Trinidad and Tobago Stock Exchange. When we take a look at the U.S. market, well, the U.S. market at the end of September 2022 was down just about 25% as well. And it also makes for painful reading where pretty much every sector barring energy was in double-digit declines, with the worst performing being communication services down about 30% and technology down about 31%. Energy, on the other hand, did rally about 30% in the positive. And that was really because, or that continues to be because of fairly significant dislocations in energy markets contributed to by the Russia and Ukraine war or standoff in Eastern Europe. A similar experience across international markets, where Europe has declined in US dollar terms down about 33.5%. Asia, excluding Japan, is down, or equity markets down about 28.1%. And Latin America, while staying in positive territory for most of the year, closed September down 3.5%. Again, relatively better than the rest of the major investing regions, but still negative for the year as at September 2022. And many of the issues that continue to plague or equity markets in the first 9 months of 2022 are expected to continue on in the immediate future. And at that local level, we're talking about somewhat of a brighter prospect with economic recovery driven by a potential energy sector recovery, perhaps improving investor sentiment coming into the next few months, but that may be offset by continued inflationary pressures, as well as the increasing cost of living, with some of the initiatives coming out of the budget, which could overall lead to weaker consumer demand. So how those two factors play off against each other, a brighter macroeconomic outlook versus a heavier consumer or weaker consumer, will tell just the direction of where local markets go in the coming months. At the international level, well, elevated inflation continues to be a major concern, and this is forcing central banks to increase interest rates, and those rising interest rates are actually wreaking havoc on international markets, both equity and bonds, as we speak. Supply chain constraints continue, and of course, those ongoing geopolitical contentions are going to continue weighing on equity markets for the months ahead. So what should an investor do? Well, it might be an appropriate time to play it a bit safe, maybe reallocate out of those equity positions and take some safer, lower risk investments such as income mutual funds, maybe fixed deposits, or perhaps repurchase agreements, which are lower risk, lower return, of course, but at least your principal has a much lower chance of being affected adversely under current equity market conditions. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com or check out our website, bourseinvestment.com, where all of our research is absolutely free. So until next week, keep safe, happy investing, and we'll see you next time on the Bourse Report.